I welcome our pathway for our members involves familiarising them with the sectors, which provides a basis for building a strong, diversified portfolio of blue chip and small cap stocks. I'm going to go through them quickly in alphabetic order. Firstly, Consumer Discretionary. We all know that the wallet is under pressure and that interest rates are not going down anytime soon. Some retailers are better positioned than others. Certainly those who sell products that are more discretionary, i.e. aren't necessities, are finding life harder to differing degrees. The shares of Harvey Norman, JB Hi-Fi, furniture retailer, Temple & Webster are all down. Super retail has been hit even harder. You would include the conglomerate Wesfarmers in this category because it owns Bunnings. Jewelry retailer Lovisa has been a notable outperformer. The earnings of all these companies are highly cyclical. Rising interest rates is a factor for sales. The key driver, however, are store rollouts and growth within stores. This is a competitive industry. You really need to include small caps because they're growing from a smaller base. Stocks we've made money from here include Kogan and Nick Scali. Consumer staples, these are generally supermarket retailers such as Woolworths and Coles. They're able to churn out profits no matter what the economic conditions because the products they sell are necessities. A big risk factor here is paying too much for earnings, but increasingly our risk is technology. Big costs involved in revamping, modernising legacy systems. Both stocks have notably underperformed in recent years, which doesn't necessarily mean that this will always be the case. Energy. The biggest company here is Woodside Energy after it merged with BHP's energy assets in mid-2022. The biggest driver is energy prices, namely the oil price, but Woodside, even before its merger, was a leader in paying out dividends. There is oil price risk, but increasingly asset risk because investing in fossil fuels is getting harder. We find that there are more opportunities in small cap energy stocks. Certainly both Woodside and Santos have underperformed even in times when the oil price has appreciated. Financials. Banks. You can't go past one or more of the big banks when you're building your core portfolio. CBA, NAB, ANZ, Westpac, and even Macquarie Group. This is a big engine room on the ASX. These have been the key drivers of the benchmark S&P ASX 200 index reaching near record levels. Consequently, these banks are more expensive than they have been for a while. What they're providing that people like, that people are paying up for, are dividends and to a lesser degree, share buybacks. That's supporting their prices. Financials, wealth stocks. These are businesses that manage people's money or associated with administration and settlements. The biggest one by far is ASX Limited, which is the listed entity that owns and operates the Australian Securities Exchange. Other examples you might be familiar with: AMP, Challenger, Insignia Financial, health insurance provider, Medibank Private. The state of the investment markets is a big determinant of profitability, but all have struggled to varying degrees since the 2018 Royal Commission into Financial Services. Healthcare. This is a great sector for getting earnings that don't relate to the general state of the economy, but you have to be careful about how much you pay. The biggest in this space, CSL Limited, provides blood-related treatments. CSL has been bouncing back from lows, which is a good thing for our members. Next, we get to industrials. On the ASX, the big ones include Transurban, Worley, Qantas Airways. Obviously, the drivers here are highly varied. Transurban, road toll operator, pays consistent distributions. Worley, consultant in energy. Qantas, all about tourism. The next sector, IT. This is an underwhelming sector on the ASX when you compare it with the US market, but should not be underestimated. So over there, they have the Magnificent Seven, Meta, Microsoft, Alphabet. Here, we have relatively big companies, but in small caps, there's the real excitement. There's Megaport, Afterpay, which we picked early on, Macquarie Technologies, Gentrack more recently. There's a lot of excitement in this sector, not to be underestimated. Materials. In this definition, we include manufacturing companies such as paper and packaging company Amcor, BlueScope Steel, as well as the building products company James Hardie Industries and Boral. These are all companies whose products are sold globally and are leveraged to global growth and construction activity. So you have to watch out because there's a lot of takeover activity in this sector. Metals and mining. This is another engine room outside of the banks on the ASX. The big participants here are BHP, Rio Tinto, Fortescue Metals. For all these stocks, the big driver is global growth. They're also building track records for paying out dividends. We have our eye on BHP, which is in the middle of a battle to try to take over Anglo American. And the key here is copper, which we're bullish on and which we cover in a report last month, issue 594 in small caps. Telecommunications, there's been a massive consolidation here over the years. What's left? Telstra and TPG, both well run, but Telstra is still the gorilla. Earnings are consistent, but both are vulnerable to disruption. Telstra's stock is paying a price for the board backing out of spinning off its infrastructure assets. The company has to do more than just sack people to rescue its fortunes. Real estate. This is a sector in transition. You might have exposure via your house, but it's important to obtain access to productive assets that actually pay income from differing tenants. Lendlease owns and develops property and is trying to turn its business around after a series of cost blowouts. Utilities. These are good ballast in any portfolio, often paying strong dividends, but you need to be careful about buying at the right price. We've done well out of stocks like AGL, Energy, Pipeline Operator, APA Group, but it's always good to remember that even these companies can be disrupted by smaller, more agile competitors when there's big structural change going on. And there doesn't get change bigger than the transition to renewable energy. So I hope you've enjoyed listening to our ASX sector review, and I look forward to our next update. I'm Richard Hemming from Under the Radar Report.